Are you ready? Are you ready? Are you ready? Let's go.
Welcome to Unpacking the Home Advantage. My podcast is to help you understand the mortgage loan side through my experience and knowledge. My name is Paige Ashby. Do you need some cash out? Want to know whether to do a refinance or a Heloc? Well, today I'm going to compare the two options to see which one makes sense for you and why now is still a good time. Let's utilize your equity to put yourself in the best financial situation you can be. Let's get unpacking. So today we're going to go through the pros and cons of a Heloc versus a refinance. Let's start with a Heloc, home equity line of credit. As you've heard, the feds just raised the rates again. These are the short-term rates, short-term loans such as car loans, credit cards, and Helocs. I want to clarify something. The feds do not control the long-term rates, which is the 30-year mortgages. But their decision does affect other market reports. Any consumer reports that come out will affect the Helocs and the long-term rates, which is the 30-year rates. Let's start with the cons for the Heloc. Now, these Helocs have an adjustable rate that ties to the feds. So the pattern has been going up every 2 months, which is very scary because the rate is around 10 or 11%, even if you have a high credit score in the 800s. So if your loan amount is high, then your payment's going to move up pretty quick, which can get pretty risky. Now, these Helocs, people think because it is a second mortgage, yes, it is a second mortgage, it goes on title as a second lien, they are much harder to qualify. So they require a lower debt ratio percentage. They will be a second lien on title, meaning your existing first mortgage, you will have that, and then you will have a Heloc, a second mortgage. 2 loans to pay. So you have to really make sure there's a benefit to have a second loan added on, a second mortgage payment, more debt. The reason why a Heloc is at higher risk is because when one defaults on a loan, the first mortgage always gets paid off first. Then the second sometimes get paid off or it gets charged off because obviously if it gets default, they don't have the money to pay it off. So charge off means that a lender tries to collect the payment from you, but they can't, so they have to charge it off their books. But when you see charge off on your credit report, it still means you owe this debt. So the loan will stay on your home as a lien. Doesn't mean you don't owe it, but it just means they cannot collect from you unless you refinance. So that means you have to clear every lien on title when you refinance. Now, underwriters on these Helocs usually are very black and white, meaning they go by their guidelines to the T. If the requirement for debt ratio is 43%, it's exactly 43. It's not 43.1. So they're pretty strict on the income docs for self-employed too. Full tax returns, no ifs or buts. They do not do any bank statement programs as, is allowed on the first mortgages. Now, on any BK, they're pretty hard on that. I think it has to be, it depends on the lender, it has to be between 7 years, which is much higher than a regular refinance loan. And they do not allow any past forbearance due to COVID. When COVID was around, everybody was able to do this forbearance program, aka loan mod, where they can skip 4 or 5 payments and then they redo their loan, which is called loan mod. So that is an automatic decline if you have any past forbearance or loan mod. Believe it or not, there is a pro to getting a Heloc. A great time to get one is when you need it for a short time, meaning you'll pay it off soon. So most of it is for like small home improvement projects because it is a line of credit. You'll have quick access to it. So if you need to pull out a little bit here, a little bit there to pay different contractors, it's a huge benefit to get a Heloc. One more thing I want to mention the benefit of having a HELOC is for investment. Now, a great idea to use a HELOC is to use that money, utilize that equity to buy another investment property. Use it as down payment. So if you're buying another investment property, a rental, obviously the rental will cover the payments. So that is a huge benefit to use a HELOC because you have access to your down payment right away. You don't have to wait for any qualification. It sits there. So a lot of my clients have a HELOC ready to go to buy properties. They don't use it for anything else. So you can go and get a HELOC for that purpose and leave it there. Leave it open. No balance. Do not use it until you find a property, and then you can use that. You can withdraw it by just writing a check or transferring it to your account to use that as a down payment for an investment property. So there's nothing wrong with that. That is a great way to use your equity. Now let's go over why a cash out refinance is highly recommended by me if you need to pull some cash out of your home. The process of a cash out refinance is to redo your existing loan into a new loan plus pulling some cash out from your equity. So there are many, many benefits, and I love to do these because it maintains one loan. So what you're doing is you're paying off some debts. You can get rid of those high credit card rates that's in the 20s. You can get rid of your car payment. Most of these car payments are amortized over 72 months just because people cannot afford these high car payments anymore. So they have to spread it out for the longest term they can, which is the worst to do. So might as well get rid of it, be completely debt-free, and just have a mortgage payment. That's how I try to recommend any kind of refinance. You don't want to add debt. You don't want to redo your second mortgage. You want to pay everything off. So you can also include a HELOC with your refinance to pay it off too. So be completely debt-free, pay everything off, utilize your equity that you have to be debt-free is the number one goal that I try to get people to understand. The cash out is a great way to do some home improvements. Big projects like finishing a basement, remodeling a kitchen or any room, because those are big projects where you don't want to carry the weight of having a second loan and have to pay that after you get all these improvements and be in more debt. Get some cash out to pay off your debts. Include some home improvement projects. One idea that most of my clients don't even think about is to pull cash out to use for down payment for an investment property. So I mentioned that with a HELOC, but you also can do it with a refinance. I have a new program that is called DSCR, and I'll have a podcast just for this program, DSCR, Debt Service Coverage Ratio. Now, this program means you do not have to use your personal income to qualify. So no W-2, no tax returns. What it means is it uses the average rental income in the area to qualify. If this rent is determined by the appraiser's research as part of the appraisal report. So you have this form as part of the appraisal. If your mortgage covers the rent amount, then you're good to go. So basically, you just have your down payment. If you have that, but do not qualify for regular income, W-2, self-employed, then you can be an investor without being an investor, if that makes sense. So this is a great way to pull cash out to let the equity work for you and grow your investment portfolio. The final benefit I want to go over for the cash out is to become debt-free. It is highly encouraged right now to just wipe out all your debts and just have a mortgage payment. Your value will go up, so let your biggest investment work for you. So the last thing I want to mention is that if you don't have a mortgage, if your property is free and clear, it is still doable for you to pull cash out. Now, if your property is free and clear, we can do a new loan. It's a new refinance loan. There will just be nothing to pay off. So you will have a new loan on your property. There's a small rule on this if you're doing a VA loan. Now, VA does not allow you to do cash out without any existing loan to pay off. They're the only one that have this rule. There's a way to get around this. I've done it many, many times. So reach out to me if you need my assistance, and I can give you the rules on it. So it really depends on the situation and your scenario. These are great ideas to utilize your equity. Let's get going. It doesn't matter what the market's like. It is, how can I resolve your problem? So the problem doesn't determine by the market. The problem is what you're going through, what needs to be done, and to utilize your equity to help you resolve that problem and give you the financial freedom. If you have enjoyed this information, make sure you give me a follow. And if you have anyone that may benefit from this, please share. More episodes to come. As an active mortgage broker and a mentor, if you have any questions, reach out to me through LinkedIn, Paige Ashby Lending. Thanks for being part of Unpacking the Home Advantage.